Hello, everyone. Thank you so much for joining us today. I think we're going to give it maybe just one more minute to see a couple people joining late here. Um, but I'm Lauren Evans, the Marketing Director of Convergence, and I'll be moderating today's session. So let's just give it one more minute here. All right, let's get started. So like I said, I'm Lauren Evans. Today we will be discussing 7 topics, and some of them may overlap a bit, but we will allot time for questions after each topic. So please put any questions you have in the chat, and I will read them out to our speakers. As you may be aware, on August 7th of this year, President Donald Trump signed an executive order titled Democratizing Access to Alternative Assets for 401k Investors in order to expand the types of investments available to participants in various types of retirement plans. The order directs federal agencies to ease regulatory restrictions and provide guidance to allow alternative assets like private equity, real estate, and cryptocurrencies to be included as investment options in defined contribution plans like 401ks. The democratization process has already begun and is expected to accelerate and add several $trillion to private fund advisors. So that being said, the goal of today's session is to identify the impact that this will have on industry participants that want to participate in this growth. And for any additional information on the topic, please reach out to our speakers, John and Nick, after the session. So as I've just said, today's speakers are John Phinney, the CEO of Convergence, and Nick Perros, the CEO of Argo Fund Solutions. John, could you introduce yourself?
Thank you, Lauren. I am the CEO of Convergence, and prior to that, I was an industry practitioner on the asset management side, both public and private funds. I founded the company in 2013 to provide data and business intelligence to the ecosystem of participants, that being GPs, LPs, service providers of all stripes, and government agencies.
And
Thank you.
hi, everyone. Oh,
Yeah,
sorry,
Nick, go
Lauren.
ahead.
Yeah, hi, everyone. I'm Nick Perros, and I'm the CEO of Argo Fund Solutions. We're a fund administrator. I've been in fund administration for approximately the last 15 years. And then before that, I sat on the buy side. I was with a couple of large managers, asset managers, private equity managers. And then I started my career at PwC.
Great,
Thank
thank you, Nick. We're going to jump right into the questions, and it's segmented really for participants on this call. So if you recognize yourself as a member of an advisor, an RIA, a service provider, again, please focus your questions on the topic so that Lauren can read them off after the session. So without any further ado, Nick, the biggest question that RIAs ask me is, John, what is the impact that democratization will have on my firm? I may be large, I may be small, I may be single manager, multi-manager, but what is the impact of democratization, and why should I care?
Yeah, and I think the answer to that question starts with, do I actually want to participate in the market? And as Lauren said at the outset, opening up 401k to the alts investment sector is great. But that number, if anybody's looked at it, is $10 trillion. And do you even get to, I don't even think, I'm pretty sure that doesn't include IRA money, which is not part of the executive order. But if that follows, I think there's another 20 trillion behind that. So look, what we're talking about is massive amounts of money that come in the form of individuals. So very different business than what RIAs have been, um, that our RIAs are in currently. And I think there's a real question to be asked. Do I want to participate um, in this pool of capital? If you get to yes and you say, okay, I think it's a good idea, ability for me to make, grow my business. I think you then get to the question of, well, how do I want to participate? In what capacity should I participate? Am I in fund advisory? Am I in wealth advisory? Or is there some combination of both the form I want to participate in? I think, look, after that, you get into the product side and you get into the infrastructure side. And how do I support the products that I'm going to get into? And, when we talk about products, really, am I going to offer, different investment types? Or am I going to specialize in private equity? Or am I going to offer all of the alts? Lending, real assets, infrastructure. You then get to, okay, well, what's the form of which I'll participate in, and really what kind of vehicles will I participate in? And like, is that interval funds? Is that BDCs? Is that some other form? Uh, and then again, I think there's decisions that need to be made there. And then commensurate with that decision comes the building of infrastructure to support any of the unique characteristics. I mean, look, we'd love to say that alts are the same, but anyone that's been in the space knows that a PE manager to a real estate manager to a direct lend manager are all very distinct businesses, very distinct operators, and then require very distinct things in terms of support. Look, I think other things to worry about are how do I even select the right manager? And considering the number of investment managers that are out there, what are my diligence criteria? How do I really think about assessing the quality of the various managers out there as I make recommendations to my clients? So, look, I think all those things are things that an RA has to think about. I think if you get back into some of the specifics of the RIA's business, what we're talking about here is a potential shift to the business model, and really RIAs focused on high net worth individuals. All of a sudden now you get to this mass or upper mass affluent investor. And again, I think we're turning up the volume in a huge way. And yeah, that's going to cause a significant shift to the business. Look, the last thing I'll say, because there are tech components, there are regulatory components that I think are relevant, which we'll cover in some of our later questions. But look, the last thing I'll cover on this point is, look, the operational stack that's in place today is going to require, for a bunch of different reasons, modification to accommodate things like, and we'll get into tech, tokenization, things like fractional shares. And look, what does the operational stack look like today? And what does it need to look like? I think are questions that need to be asked and answered.
Thank you, Nick. We'll open it up to the audience for any questions. Yeah, I'm going to ask Nick a question about, again, and maybe in the form of a playback, but Nick, you talked about defining oneself. A lot of managers today do lots of things. They service funds, they service SMAs, institutional and non-institutional SMAs. So at the end of the day, post definition of how do I want to participate in that potential new money, it's one of definition and clarity. Two is, am I set up for it? Do I have what the products that investors need? Do I have the geographical reach that some of those investors need? So it's about, if I want to participate, what's my state of readiness? And then really three is, how do I ensure that my brand and what I am is conveyed to the marketplace through partnerships and other types of venues? It's very important because, as Nick mentioned, with so many RIAs that advise funds, I call those return creators. Then there are wealth advisors who produce what are called allocation schemes, et cetera. Then there are hybrids. Okay, so Nick, do you see definition as the most important thing, or do you see state of readiness as the most important thing, or how? What's your view on that?
Yeah, look, I think they're both equally important, but if I take definition, John, and like you know this, we were the manager together, and I think you start as one thing and you specialize in something, and then you get ultimately investor feedback that says, hey, you're pretty good at that one thing, but I'd like diversification. And at that point, why don't we try this other thing? So I'm a PE, I'm a good PE investor. Okay, why don't we try real assets? Why don't we try infra? Why don't we try credit? And so I think you may start focused on one thing, but ultimately the way investor sentiments ultimately end up, particularly if you're a successful manager, is I want to give you more and I want to allocate more to you, but give me a little product variety. So, look,
Great.
I think
Thank
again,
you, Nick.
both are important, but I would see that as evolutionary.
Great. Lauren, any questions from the audience before we move on to topic two?
None so far.
Okay. Don't be bashful, folks. Nick, this is a question directed at you, and it's sort of an extension of the RIA question in a way around the state of readiness. Um, the marketplace believes that valuation, particularly in the less liquid securities, and now we're talking about credit primarily, that valuation will be one of the single biggest challenges. Would you talk a little bit about that from your perspective and given your background and
Yeah.
also Argo's view?
Yeah, and so look, I was at a manager when they went public. I was at two managers when they went public, and I'll take my cues from what happened there. All of a sudden, valuations became, no, no, we can't wait. We need them done in 3 days. We want to report in accordance with what um, other financial services organizations are reporting. So all of a sudden, we had huge changes that fell upon us operationally that we had to manage. We had to create different processes. We had to put different systems in. And I think you take that, and I take that as a cue for what's going to happen um, when now we get into, let's call it a semi-public, if not ultimately a public state, which is what, 401k money is investing in today. So what's going on with their valuations? I mean, they have daily, they have hourly, they have valuations up to the minute on every position that they're invested in. Well, okay, maybe that's something that we're going to have to be thinking about in our industry. Transparency and disclosure, so frequency, yeah. Transparency and disclosure, I think, also become paramount. And, you know, how are we providing information to our investor group, I think about how we prepare valuations becomes incredibly important. And if you look at um, the SEC, I know just recently filed a case against a very large manager. And, really the issues are control over inputs and the model. And at that point, what we were doing, which is running DCFs, and it's my secret sauce, all of a sudden becomes, no, no, that doesn't fly in a quasi-public environment. Um, I think you then get to standardization, and clearly standardization is something that exists in today's public markets when you think about valuations. So my model versus John's model versus Lauren's model probably has to go away and probably needs to fall into a standard. um, I think another issue that's key in the valuations of democratized assets is like independence. So, and I can tell you, as I look at my clients on the private capital side, the valuations are done in-house in large part. Again, it's the secret sauce of the investment firm, and that how they come up with valuations. And yes, many of the larger firms have an independent firm provide them with negative assurance. Um, but is that good enough in tomorrow's market? Is that good enough for democratized assets? And no crystal ball here, but my guess is independence of valuations is going to play a greater and greater role. Last thing I'll say, look, the technology whereby valuations are produced today. If we go back to kind of the public nature and the frequency and the volume, yeah, we got to get ready for the industry needs to get ready for daily valuations and daily reporting of those valuations. And again, huge change from where the industry stands today, which is quarterly reporting and then annual audits.
Thank you, Nick. Okay. So, Nick, the significant discussion around democratization into private investments involves credit, and obviously direct lending is a very big topic. And if you listen to a lot of the leaders in the industry, CEOs talking about the importance of credit, both on the provision side and also on the servicing side, um, you're talking about your model-based valuations by and large. And we know how complex it is to value portfolios of loans, where there might be hundreds or thousands of loans that have to roll up into an NAV, and it has to be tested, et cetera. So for the audience's benefit, um, could you talk about or provide some maybe black and white insights on this whole concept, not even concept, but this practice of mark to model, and what are the sort of the do's that people should consider either for their own funds today, or if they're going to participate in democratization, to your point, transparency into the model selection, transparency into the inputs, description of changes, et cetera. Uh, who would you give the advice to within the organization, and what tips would you provide?
Yeah, so look, I think this becomes look, consider the impact of valuations, whether it's on the credit side and the traditional equity side, on any given fund. Really, investment in is the NAV. And look, at that point, I don't think, John, this is about the accounting department or about the deal team or about any one segment of the firm. For me, this becomes an issue that um, significantly changes the entire firm and their approach to things. And it's what are the inputs and do I control the inputs? Or really, what are the standards? And do I adopt the standards? These are huge changes. And I believe they are firm transformational, and they are certainly process transformational. We're talking about volumes of unheard of number of investors for the private capital side. And again, that applies to the credit as well.
Okay, thank you, Nick.
Look, I think part of you, John, I think is egging me on to kind of the next question, and I've touched on it a little bit, but technology. Really, maybe you can cover a little bit about the tech side and for how 401k sponsors or non-institutional investors can make how technology will work in the context of those types of investors.
Sure, Nick. And I think I'm going to leave the service provider technology question to you, because I think you'll cover it when you talk about the impact on service providers. I'm going to focus on the investment advisors on this call, and I would strongly urge everybody to really understand tokenization, what it means, how you can get involved in tokenization. And I'll just define tokenization as the creation of objects, data elements, call them what you want, but digitized records, which include things like the LPA, the PPM, the financial statements, DDQs on the firm, pricing methodologies, risk sensitivities, both on the investment and the non-investment side, pricing transparency in terms of the NAV, et cetera. These tokens are being created as we speak, and we listen to a lot of our clients who are leading asset managers, and they are telling us that within 5 years, if you do not tokenize, quote unquote, your limited partnership interests, the democratization market you will not participate in it. You just won't, because everything will be through tokens, which are then put on platforms, blockchain type platforms, so that liquidity can be provided for fractional interest in private equity funds, for example. The institutional market, so the institutional investors, they may not require initially tokenization of LP interests, but these advisors who we speak with say it doesn't matter whether they care about it or not. In the future, we're going to provide the LPI, limited partnership interest, in the form of a token, so that they can then, if they so choose, sell all or part of their LP interest, depending on the provisions of the LPA. And that is an interesting evolution, because if you think about the role of secondaries today, secondary funds, they're a source of liquidity. So, what happens to the secondary funds going forward, right? So I would say technology broadly based is tokens, blockchain, and if you're ready for it, then you'll be able to at least take a step towards participation.
Hey, John, I know we have a couple comments in there, but you say words, if I can sneak a question in, you say words like tokenization, you say words like blockchain, and I'm thinking, wow, is this all the domain of, and therefore democratized assets limited to the larger institutionalized managers? Or can I, as an RIA or as a family office or as a smaller allocator, are these assets available to me in the context of what is otherwise or otherwise scary words for me?
Well, look, it's a transformational technology that's already going on. Plenty of companies are doing this, so it's real. And when you listen to the big managers, and again, specific for a moment to democratization, which remember is the non-institutional investor, in order to provide liquidity, particularly to the less liquid asset classes, tokens are probably one of the few ways to go to create that liquidity, or you're not going to be able to provide it, which is a key tenet of democratization, is how do we, and by the way, you can get through interval funds and tender offer funds exposure, right? But if you're talking about direct access, which is really what the larger players are hoping for, and what I think the executive order that President Trump has requested is, hey, it's great to get this all embedded within public funds, but direct fund access is also sort of a serious item on the table. So I think while it might be scary because it's new and maybe a lot of people don't understand it, that's the point. Get to understand it. Understand if you want to participate. If you don't, you may not have to worry about it because you don't care. But I think the institutional investor is going to find that an attractive feature going forward, because today, when they go, in a closed-end fund, it's realization based, and sometimes these plans they change and they may need intermediate liquidity before realizations take place. So I think it's going to get there more slowly on the institutional side, but the manufacturer of the returns, the fund managers, I think that's going to go part and parcel. It's going to be an option. You can use the old-fashioned way, and all the friction, as we all know, exists in just onboarding a new investor. But through tokens, it's a very tight, very transparent, very consistent way to offer those interests in the future. Platforms, meaning the blockchain that those tokens will sit on, Nick, that's still emerging, right? But Ethereum is one of the more quoted platforms where these tokens in the asset management space, particularly the fund management space, are likely to, rear their heads.
Thanks. That's a great point. And we did have two questions. I think one of them was partially answered, but I'll ask it anyway. How will these investors come into a fund like an intermediary partnership, mutual fund, or ETF? And will the investment partnerships move toward publicly traded partnership position to MLP position due to the need for liquidity of the new investors?
I, the answer is yes to each of them, and they're manifesting already, not through the tokens, but through access. So you can get access to alternative exposure through interval offer funds, tender offer funds, CITs, collective investment trusts, et cetera. Now, the mass adoption, right? So this is like I call it the inchworm kind of approach, because direct access, meaning the ability to come into these entities directly without the traditional kind of approach we all know about today, I think will be greatly accelerated through these tokens. And whether or not the platforms that emerge are localized within the asset management community, where, let's say, advisor A has a place on the Ethereum platform, for lack of a better example, where they can go and discover what they want, right? You got to remember one thing, and segueing back, the wealth advisors who are advising the money, not the manufacturers of fund returns, but the wealth advisors, when you look at a family office or a 401k plan and they say, we want exposure to private equity. As Nick mentioned earlier, there's like 4,000 private equity managers and 35,000 private equity funds out there, right? How do you discover which ones to go to, right? If everything is tokenized, then AI will enable discovery in lightning speed, right? Just like these robo advisors today are created in the public space where, I want so much of my portfolio in ESG, and within ESG, I want climate, or I want social programs, whatever it might be, right? All of these flavors of exposure that people want through the robo world, I think it's going to find its way into the private markets first when tokens become more abundant. So when you think about it as an RIA, I talked about, hey, I want to be in the market to participate in democratization, but nobody knows me. Well, guess what? You don't need a fund marketer to go after those communities of institutional investors. It's not possible, right? Yeah, you can deal with the private wealth platforms, the IRAs, WS directly, or the wealth advisors directly. However, if you really think about a token being discoverable, meaning its elements are discoverable through AI, now all of a sudden you're going to save a huge amount of cost, because those wealth advisors will perhaps enable you directly or indirectly to find what you're looking for. And as I know, and Nick knows, not all managers are created equal. They don't all do the same thing. Everyone has a nuance, right? A special nuance. And so therefore, the discovery of those nuances, I think, is critical. So I hope that answers the question about how are they going to come into these things. It's, first of all, discovering what's out there. And then secondly, through these platforms that are emerging. By the way, there's platforms, there's lots of banks putting out these platforms that marry up investors looking for LP interest and funds, right? So a number of the banks, I'm not going to quote them, but you can look it up. There's 4 or 5 big ones. And then there's a lot of fintech platforms and blockchain platforms that are evolving as well. So I think a token is a token, and whether it sits on a bank platform, proprietary platform, or it sits on a blockchain, It's going to depend on, the provider, but you as the investor or the investor is going to be able to discover. And that's the key, is discovery and transparency. And then the investor is going to make their own decision anyway.
Yeah, if I could just chip into that, access and liquidity, I think is the baseline of the question there. Look, we,
Yeah, well,
we are
listen,
able,
price discovery is price discovery.
yeah,
Meaning, if you're looking at fund X and it has a current NAV of Y and a basis of Z, and then you're able to see through the blockchain what's traded, meaning the tokens that have exchanged hands at prices, you get to start seeing the diversity of interest. You get, I'll call it the bid ask range will emerge over time, right? Um, you know, these platforms, by the way, existed years ago for stock option plans issued by companies where they had to be tracked at the NAV, or the value of the securities had to be addressed. But it was a very tight community, and employees could trade these things among themselves, and they could also trade to a broker who would make markets and some of this stuff. But at the end of the day, I think, Nick, price discovery is part of the token process,
yeah,
and you
yeah,
you can you
yeah,
can you can you can you can offer what you want, and whether or not the token owner or the person that owns that interest, when they see it, they either hit it or they don't hit it.
yeah,
It's an oversimplification, but I think that's what we're moving toward with tokenization and blockchain.
yeah. And I guess the point I was going to make was, look, we're taking some of our cues already with how the existing retail segment has started to address these, right? And I think a lot of what you're talking about is extension thereof. Look, I guess there's a long way to go between the signing of an executive order and the actual application and the administration of that. And I think there's a lot of work to be done there, right? And yet to be defined. So the SEC, and I think ultimately the Department of Labor get involved in terms of trying to decide some of these. So I think, do they build on what's already in place? In all likelihood, yeah, right. But I think the administration, in terms of access, in terms of liquidity of that, I think is somewhat undefined as of now.
Hey, Nick, today, and we'll move on. I'll make this last point. The secondaries is kind of the market is kind of a proxy for price discovery in a way,
Hmm.
where if you get a big secondaries and they specialize in private equity or real estate, it doesn't matter. And you're an owner, and you want to sell your interest, you're not going to get the NAV.
Yeah,
The NAV is the NAV, right? It's financial statement concept, and we all know what that means. The marketplace, if you will, very general term, but will eventually, the technology, regardless of the regulation, just for a moment, right? We're going to get to regulation at the end. But regardless, is the technology is already there. It's being developed at rapid speed. Tokenized companies will come in and help you tokenize everything. Then you need to figure out the platforms for those tokens, right? And then there has to be adoption, right? Who knows, Nick, right?
yeah,
You're absolutely right. Who knows? But we'll talk about that at the end. Okay. Thank you very much.
Great, thanks. And we did
We're going to
have
go to
one other,
service providers. Yeah. I'm
yeah,
sorry.
we did have one other question.
Okay.
It goes back to valuation. So I do think we covered some of it, but what do you think the appropriate frequency of valuation or NAV updates should be in the 401k framework, and any large differences you see across different strategy types?
yeah. Again, look, I mean, the highest frequency is what you see today in the public markets. And again, I take my cues from, look, what are 401k assets investing in today? And I'm buying and selling all day long. Mutual funds, ETFs, whatever, equity, debt, whatever's available within the portfolio. And you look, the valuation of those is daily. And look, increasingly, so I think that's the minimum. Sorry, that's the most or the highest frequency that you'll get. Arguably, does that even turn to trading on the minute? Look, potentially, sure. But yeah, look, I think we can get to a daily valuation environment in terms of frequency.
Yeah, and I'll make one point on that. I think the asset managers, particularly in the less liquid space, will need to meet certainly a more frequent valuation cycle than they do today. But mark my words on this, your ability to back test your exit against your prior mark is going to be very important. And it's not for the purpose of if I got you, it was right or wrong. It's just about the process, learning from the process, because we all know who've worked in the model space, okay, that you can tighten up and make more frequent valuation models because the inputs are the inputs, okay? A lot of them are based on things like EBITDA multiples. Those don't change overnight. Company results, okay? EBITDA's up, down, sideways. So at the end of the day, the question is, what's the frequency of the inputs that are coming in? And that's going to have to be a consideration inside the token. For example, valuation policy will be inside the token so you can read it transparently. And is there any competitive advantage in just being transparent with valuation policy? No, right? There shouldn't be. But I will tell you, some valuation policies are better than others. And if I were an investor, and I was seeking to determine, which valuation policy fits the asset class that I'm going to invest in, I'm going to try to find the one that best aligns. I can't say it's going to be daily necessarily, aspirationally, theoretically maybe, but it's going to be a lot more frequent than today. I can tell you, any PE manager on this phone call, particularly on the investment side, they have a lot of insight into their companies. Believe me. So if there are changes, material changes in the inputs, they will need to update them more frequently if they want to participate in democratization. Okay.
All right. Thanks, John. Next topic.
Okay. Thank you. So, Nick, please, we talked a lot about valuation, the impact on the RIA. Could you talk about the impact on service providers? Now, there's a lot of service providers, so we're going to isolate it to really fund administrators. But if anyone on that call is an auditor and you want to, ask a question about the impact on audit, we can answer those questions as well. But, Nick is the CEO of a fund administrator, so why don't we start there?
Yeah, thanks, John. So I think volume right off the top is something that, so we talked about frequency, we talked about volume as relates to valuations. Look, I think all those play into the operational aspects of the fund administration and the fund administrator. And the regulatory scrutiny, just to kind of highlight some topics very quickly. Certainly, I think as opposed to today, where, yeah, we've got Form ADV, we've got Form PF. Yes, we have some Cayman regulations. Yes, we have AIFMD. But I think regulatory scrutiny is something to be dealt with. Like a big impact to the way fund administrators operate today, certainly on the private side. I think on the open-ended side, I think some of this is already being addressed, but liquidity. How do you handle liquidity demands of the investor base? I think brings huge change to the operating environment of the administrator. Certainly additional reporting and additional transparency. And look, the industry is very comfortable with the ILPA standards that have been put out there and the reporting, and everybody's adopted and adapted to the ILPA regime. But I think we're in store for enhanced reporting, enhanced transparency, all of which then, if you take all of that together, I think you get into the really technology side of the equation, and look, great people will no longer be enough. And look, we at Argo certainly believe in the great people pulling the levers of technology, and that's the approach that we take with our clients. But when we're talking about massive volumes, that are anticipated with democratized assets. At some point, AI, machine learning have to be embedded into the technology footprint of the administrator who's going to be able to service this, this part of, a manager's client base. I think you're also going to get into, so specifically, what does that mean? Well, how do we manage subscriptions? How do we manage AML? How do we manage cash movements? All those things are not tens or even hundreds of transactions. We're getting into thousands and tens of thousands of transactions. So, like, I think democratized assets become game changer for the entire industry. And I think the forward thinking administrator has today not only buttoned down technology, which is to say, connected, truly connected from the start of the process all the way to the finish of the process. So, ingestion of cash all the way to portal reporting, and then really connected with the client. And so, I think connectivity within the system, and then connectivity to the client, and ultimately to the client's investors. That's just baseline. And now we get to, okay, how do we handle volume? To me, if I was in the market for an administrator, I'd be asking those types of questions.
Okay, Nick, given what you just said about the evolution uh, between private and public servicing, um, certainly frequency, volume, important considerations. Do you believe that uh, pure play private fund administrators need to expand their offering to public funds? Because we certainly see a bifurcation in the market, meaning some administrators, particularly the larger ones, do both public and private. Okay. Then you have the pure play publics and the pure play privates. How do you see that as the CEO of a company, fund administrator who focuses today primarily on, I think, privates?
Yeah, and look, I think it's back to what we were talking about. That's going on at the manager, right? And we all take our cues from our clients, and our managers take their cues from their investors. And where's the capital coming from? And earlier I talked about expanding the product. Hey, you're a great manager. Can you get me into, you're great at PE. Can you do real assets? Can you do infra? Can you do credit? And look, I think ultimately the answer to your question, as far as we think about it, I think about it, is that yeah, the service offering of the administrator needs to have broad-based capabilities in response to the requests that are provided to it by its clients. And as that evolves, I think public and private start to merge into one offering.
Thank you, Nick.
Hey, John, we talked a lot about the environment. We talked about RIAs. We talked about the impact on service providers, and valuations. What about the LP side of the equation, John? How should investors be thinking about this?
Well, I spent a lot of time talking to institutional LPs about this, and many of them haven't thought about it the way I'm about to articulate it. So, for anyone on the phone who touches LPs, you can spread the message. But in bullet form, one, I believe that their capital, which has been very valuable to the historical growth of the alternatives industry, is going to lessen, meaning it was all institutional LPs that drove this massive surge in alternatives. With competing capital flows from 401k plans, et cetera, that that changes the balance of power, if you will. That's going to impact their ability to negotiate fees, et cetera. Again, for those LPs who are dealing with managers who have decided to participate in alternatives, that will be a consideration. Co-investment, which is sort of an inducement in many ways for larger allocations from institutional LPs. The need for those may lessen. It's likely they're going to lessen. Okay. Um, Again, for those who are accessing capital from the public markets. Then, in meat and potatoes terms, listen, there's not an infinite supply of great investments. In the old days, when you looked at the institutional returns on many plans, significant returns came from alternatives. And don't get me wrong, with upwardly moving markets, the rising tide lifts all boats. But the whole purpose of alternatives was uncorrelated return, diversification, right? So you're going to see, if you will, um, lower allocations to the best investments. It's just natural, right? Then you're talking about things like expenses. That should be a positive in a way, meaning, hey, if expenses are finite or fixed, relatively speaking, it's spread over a larger body of funds or assets. Expenses should go down, right? And the last item is what I'm going to talk about is risk. Um, the the addition of alternatives to, let's say, a manager who's traditionally catered to institutional investors, at the end of the day, taking on um, non-institutional investors, it's just going to introduce more risk to the RIA, which has a ripple effect onto the risk of the institutional investor, right? No newspaper ever likes to get the facts into the headline. It's X pension plan exposed to Y manager who just did something terrible, right? So reputational risk, returns, etc. I think there's going to be a change in that schema, and it's going to require LPs to make decisions in the future on what they want out of their advisors, right? Do I want pure play alts players who don't take the democratization route? And if so, then they should be okay, right? There's plenty of managers we've talked to who say, well, we're going to stick to our knitting. We got a great institutional base. We're going to continue to service them. But the attraction of even a 10%, 20% allocation in the future to alts, to Nick's point, is worth 2 or 3 trillion in money transforming from public to private, and then you get future growth. So it's not something that the RIA or the advisor can ignore. They have to think about it, and therefore there will be a ripple effect on LPs.
Yeah. Hey, John, is you talk about risk there, and I actually was thinking about this earlier. Are 401k investors aware of the risks associated with alts investing? Is really the question I'm asking. And I think it goes back to some of the transparency points that we made and the valuation frequency and the regulation. But I mean, do you have a view there?
Yeah, I would start with the plan sponsor. Forget about the participant for a minute, okay? The plan sponsor is responsible for assembling the product shelf, right? Today, 99.8% of all 401k money is ETFs and mutual funds, all right? Part of the executive order and part of the Retirement Savings Modernization Act, which never got passed 2 years ago, it was caught up in the whole political drama. But at the end of the day, the legislation is trying to clarify the legal liability to a plan sponsor, because I can use a perfect example. Many of my employees want on my 401k shelf, which is all mutual funds today, they want access to cryptocurrency funds that do cryptocurrency, et cetera, right? If that blows up, they lose all their money, and I'm talking about the investment side, they're going to sue me. If
Right.
the advisor does something terrible, they're going to sue me. So the legal liability is kind of dampened. I mean, people could put this stuff on the shelf. You could do it now, right? But the sponsors won't do it. Now, Nick, education. We're going to talk about this a little bit when we talk about, you know, the regulations, et cetera, and the impact on client management. RIAs who want to participate in this, they're going to have to figure out how to create broad-based education. So I talked about tokens should be loaded with education, but if you really look at the industry, the regulators provide some level of education. The SROs, ILPA, AIMA, MFA, they provide some education, but the type of education that's needed is really the education of what is this asset class, what are its real challenges and opportunities, how important is the advisor's infrastructure, forget about making good investments, but how strong is the infrastructure to deal with this complexity, and can I convey that as part of the education? So the plan participants, the employees, need education. The sponsor, when they're looking to put this stuff on the shelf, they're going to have to probably go through a checklist of things. So the consultants will have a field day with this and trying to advise LPs on how to think, how to advise plan sponsors how to think about the educational side of the equation.
Yeah, and I know we're going to get into this when we discuss regulation, everybody's favorite subject. But yeah, look, I think what you're getting to is a little bit of self-policing and a little bit of foresight into the approach that is ultimately the marketing and the education of the investor group. And yeah, look, for me, I think it's a critical change. Sorry, it's an incredible change from where we are today, and not having to explain products. I think that education then becomes really important in terms of being able to do this and attract the capital and do this in the right way. So yeah, thanks
Yeah,
for that,
Vic,
John.
one thing I'd add before we go on to the last topic, but the wealth advisors that I've spoken with, so they have the clients. They have, some of them have thousands of high net worth clients, and all those clients are asking the wealth advisor about alternatives, right? How do we get more exposure to alternatives? And they're looking to the wealth advisor in part for that education. So
Mhm.
with that, when that wealth advisor begins his or her discovery process of what's out there, part of what's in that token in all likelihood will be some level of education about the firm, the asset classes, how the firm manages them, how they think about them, et cetera. If you think about the old pitch book that talked about this is the philosophy of Mr. Smith or Miss Smith around investing in these markets. This is what we look for, why we look for it, et cetera, et cetera. And then obviously sophisticated investors, the institutional crowd, they understand the implications on operational due diligence, meaning, all right, so you're going to do all these really cool things. Someone has to support it. Well, there's really no real way today, wholesale way, to understand operational risk. And companies like Convergence are moving in that direction of providing risk assessments, et cetera. We're not a due diligence shop, but at the end of the day, we're data driven and create these observations. But I think all of this is going to have to be far more transparent in the future. Maybe it's the DDQ is just expanded, integrated with, you have one industry standard DDQ that has a lot more integrated in it. I don't know because every asset class is a little bit different, but I think that's going to have to happen.
And I know we are sneaking up on our hour here, and we saved the best for last, John. I know a subject that's near and dear to your heart. But what about the impact on regulation and what can we expect there?
Well, the executive order was issued. It's 180 days, is the timeline. There has been some early feedback from the DOL and the SEC, and some of the SROs have talked about, well, until we figure it out, you can still gain access through the public funds, right? Interval funds, tender offer funds, liquid off. So that's a good safe bet because in theory, they're regulated, they have boards of directors, et cetera. I would tell you, however, if any of you know boards of directors and public funds, either singularly or in group form, many of them don't understand alternatives. So be careful. There's a lot of liability on these boards, and they need to consider that. But let me get specific. The DOL, before the recent administration came in and began to transform these agencies to be, more efficient, which has been the course of action. Make them more efficient. Lower head count. All right, lower head count. Well, the procedures are antiquated. They're ancient in some cases. We know up front and close how they do their work at the DOL. They are responsible for overseeing 800,000 plans and millions of investors. Okay, their audit capacity was always challenged to begin with, and that was with mutual funds and ETFs, mind you. Okay, so when you introduce alts, it's a whole different ball game. So there's going to be a need as they get through effectiveness. So the DOL's dealt with efficiency. I think 20% staff cuts, whatever. But they're going to have to deal with effectiveness. Like, how do we now, because they're responsible, by the way, for the safety and soundness of the retirement system of the United States. It's not the SEC, it's the DOL, right? And they were already shortchanged with resources, et cetera, and effectiveness in terms of coverage. If they were lucky, they could do 800 reviews a year on 800,000 plans. And don't get me wrong, there's a barbell here. You get the big plans and the little plans, but at the end of the day, tell that to the beneficiary in a little plan that never gets looked at, and then they get screwed, right? So the DOL has to step up to this effectiveness. The efficiency is being dealt with already. So I think there's going to be a lot of change there. The SEC tried to do this under the prior administration. The private fund rule, which got overturned by a court, was an attempt, albeit a heavy-handed attempt, to frame around private funds what I call public fund practices. Okay, not exactly. They didn't want to regulate these funds, but they said there needs to be the vestiges of public controls, right? Things like complete fee transparency and audited financial statements and all that. And don't get me wrong, it was heavy-handed. People can look at our comments; they're public. We did provide a comment to the SEC when that came out. The other rule was the outsourced service provider rule. There's huge systemic risk that the SEC was concerned about with unregulated service providers, right? So there was some rules put. Well, the rule was never implemented, but it was designed to tighten up a little bit the parameters around due diligence conducted by RIAs on service providers. So the point being, Nick, you said this earlier, and I'll finish with this. The industry has to step up. The private fund industry has to step up if they want to participate in the democratization. They have to change their thinking around transparency and control environments and institutional infrastructure. That term is ancient. Data quality, et cetera. They have to change it because it's not going to fly in the let's say non-institutional space, and it's just going to take a couple of blow-ups to get the legislators, the politicians, to legislate against this, and that's going to kill the golden goose. All right, number one. And two is, I don't care how big or small you are, if you have that kind of framework, that control, transparent framework, you can do some of the things we've talked about on this call. You will position yourself to be a participant in some way. We'll do another set webinar on the other topics based on feedback you give us. But at the end of the day, this could be like a big boys game exclusively with like the top 50 advisors out there. They'll just control it. Or there can be other opportunities for smaller, more specialized names, RAs, like Nick mentioned earlier. But it's not going to be because you have just good returns, right? It's going to be the compendium of things that we've talked about: technology, control environments, transparency, service providers that you choose to do business with, and leverage and grow with. That's how I would conclude the regulatory component.
Thank you. And thank you both for such great insights today. Thank you to everyone who participated and tuned in. And we will be sending out an email with a recording of this, as well as a survey, so that we can see how we can better serve you all in the future with another webinar. Any closing statements from either of you?
Nope. Thank you all.
Thank you.
Bye.
Bye-bye.